Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of InkResearch.ca, Canada's first online financial news and research service, providing insider news and knowledge to investors. His website, CanadianInsider.com, home of the Canadian Insider Club. Welcome back to the show, Ted.
Jim, thanks for having me back, and thank you to everyone listening in.
Ted, what could boost U.S. stocks to new highs?
Well, in the last show that we did a couple of weeks ago, I reported that our overall U.S. sentiment indicator was suggesting that U.S. stocks were going to have some headwinds here. And since our show, they have yet to put in new highs. They're within a percentage point or so of it, but they're really struggling to break through. We will have to see if they make it through or not sustainably before entering into a correction. I still think it's at least 50-50 that could happen, but as I explained last week, our U.S. indicator isn't infallible. It has a pretty decent track record under normal market conditions, but when you have the Federal Reserve pumping in money, so much money that the banks don't even know what to do with it, and interest rates are at zero, well, then your fundamental and sentiment playbooks they can be subject to a few monetary wins and surprises. So we still think that U.S. stocks are going to struggle here. We're not all that thrilled about the broad U.S. market, passive investing, which everybody had basically drilled into their head over the past 3 decades, and picked up steam as more and more ETF companies started making money off of that strategy. Kept saying buy and hold, buy and hold. Well, it paid when in the last decade when you had zero interest rates and you had limited government spending, so a kind of a ho-hum economy, not a lot of volatility. Sure, riding the fortunes of Amazon, Google, Facebook, which is essentially what you were doing, Microsoft, which is what you were doing when you were buying and holding. Sure, that worked, but it's not really working this time now because we have a new regime in Washington. Whether we like it or not, I live in Canada, so it doesn't impact me directly, but it sure does impact me and everyone listening in terms of their investment portfolio. And we have to play the cards we are dealt, and we've got an activist government in Washington. Government is getting bigger, and that's going to impact markets. And that suggests to me that the playbook that worked last decade will not work this decade. So buy and hold. You want to listen to the propaganda that comes out of the ETF companies and some of the major players, fine. But I choose not to, and to look to maybe towards something that might be more akin to what's happening in the investing environment now. So what do we see that could, though, help U.S. stocks break out to the upside? Well, in our U.S. report we sent out to clients this week, we did a look at the financial sector, because the financial sector is making new highs in the U.S. So that is, for the bulls, that is an encouraging sign, because if the financials are moving higher, that strengthens the case that U.S. stocks in general, the broad market, will move higher. Not guaranteed, but it does strengthen the case. So we took a look at, on our rankings, what were insiders pointing to within the financial sector in the U.S. as being an area of opportunity, and it kind of surprised us. In our top 10 stocks that's in the report, 4 of them were consumer lending stocks, which is quite remarkable because right now, the U.S. savings rate is personal savings rate, as calculated by the U.S. Bureau of Economic Analysis. No, it's just shy of 15%, which is very high. Now it's down from its I don't know if it was all-time high, but multi-decade high, a year ago when the pandemic was just ripping and the government was sending out the checks. But still, it's well above its high of last decade, which was 12%, set very briefly in December 2012. So if we were to see the U.S. Consumer lever up a bit, start taking on more debt, there's a lot of firepower there that could really juice the U.S. economy and, some areas of the stock market. So, that's an interesting area to look at. The financials in the U.S., we thought we might be dominated by banks, but no, it's dominated by consumer-oriented lending companies. So, keep your eye on the U.S. consumer. That's one factor in the U.S. market that probably hasn't changed from last decade is the importance of the U.S. consumer, given how big consumption is in the U.S. economy. And if they start to take on more debt, look out. We could, we really could be in for some roaring 20s here.
Oil and gas stocks have been the big winners so far this year, but what's the key there?
Well, they've been the big winners in Canada, and it's interesting because, when Joe Biden won the election, the conventional wisdom was that oil and gas stocks were done for. Well, as it turns out, Canadian oil and gas stocks have not been done for. They've actually done quite well, and the S&P TSX Capped Energy Index is the leading index in Canada in terms of the sectors this year. It is up over just about 50% year to date, and that beats basically anything you want to throw at it, Jim. The Canadian energy stocks have done very well, and so it's important to look at why has the energy sector done so well here. Well, I think that Joe Biden has really taken aim at oil and gas supplies. He wants to reduce the supply of oil and gas, primarily oil in the United States, and that one theory is that will help drive up the price of oil and make electric vehicles more viable, and some of these other alternatives that he's trying to promote is more viable. So while he is also trying to restrict some drilling and activity, if you're a producer that's already got the infrastructure in place and already is already pumping oil, it's actually turned out quite well for you because oil prices are on the rise, and if you're pumping oil as a producer, that's excellent for you. And Canadian oil and gas has been surprisingly a big winner from the Biden administration, notwithstanding his day one clobbering of the oil patch with the Keystone XL pipeline permit suspension. So while that was bad for the pipeline companies, and it's so far for shareholders in oil and gas stocks, it's turned out to be okay. And as more than okay, it's turned out quite well. However, within the oil and gas space in North America, there are differences. It looks like, for example, the Canadian sector is outperforming the U.S. sector. Why is that? Well, you do have policy uncertainty in the U.S. with what's going to be happening with the environmental regulations. Where in Canada, we kind of know what we have. Yes, we have a federal government that's kind of, tries to play both sides of the coin, the environmental coin, and we're going to sustain jobs coin. But we know that. We've been dealing with that now for a few years. And we have resources that are primarily provincial jurisdictions, and the Alberta and Saskatchewan governments are quite, pro oil development. So we have a decent regulatory framework in Canada for oil and gas, and it's showing. So the Canadian oil and gas stocks have done quite well. They're up, over 50%, and that's a bit better. That's the major energy index, versus the broad U.S. index, which is has done well as well, but not quite that well. And when you factor in the currency, it's even a bigger advantage for Canada, I believe. So it's been looking good. Now within Canada, big versus small. Well, big oil, the comfort of big oil and the big oil producers, that's been a false comfort. It's been the smaller producers that have really outperformed here. We focus on a number of them in our reports, and interestingly enough, a couple of the ones last year that we identified as having short squeeze potential have done very well in this year. And who hasn't done as well? Well, it's the big independent Canadian integrated oil companies. And I mean, they've still gone up. They've still done well. You haven't lost money in them, but they've lagged the smaller names. And why is that? Well, I think one of the major reasons is climate change, and their size makes it much harder for them to go with the flow in terms of where investors are looking for climate type solutions and commitment to reducing greenhouse gas emissions. Now, I know that's a contentious area, and the approach we try to take at Inc. is just to take the cards we're being dealt. And we're being dealt with more and more shareholder activism, environmental focus on ESG, and that's environment, governance, and societal. So ESG. So E is the big one for us because we're so resource based, and environment's going to get a big focus. So we look at the environment approach for all the companies we follow in the oil patch. And I can tell you, some of the bigger ones, they have big challenges. While I think, every company just about that we follow is moving in the right direction, it is harder for some of the big ones to keep up with the changes that are happening. It is easier for the smaller ones. And not that all the smaller ones are doing it. You have to be very careful, but the bigger ones, you have both cultural denialism. I think there's still this slow even or reluctance to view addressing climate change as an opportunity with investors. Okay, whether you believe in climate change or man-made climate change, whether you believe oil companies should be addressing it or whether you don't believe it, I'm going to say that's not when it comes to investing, that's not really relevant, because there is a movement within the global investing community to look at oil and gas companies and ask, what are you doing on the climate front? So if you are not perceived to be doing enough, then you will be penalized in your stock price. Your cost of capital will go up. So I think we're seeing that in some of these larger names. And in our report on Friday to investors, we were going to be contrasting one of Canada's largest oil companies that is moving in the right direction on addressing climate change in our view, but it is not moving fast enough. And it's not moving fast enough because events keep moving ahead of it. For example, just last month, a court in the Netherlands ruled that oil giant Shell must cut its carbon emissions by 45% by 2030. Okay, so this is a court that's inflicting this. Now, you may not like that, and fair enough. And Shell doesn't like that, and they're appealing it. But if this court is setting the rules, and then you have all these ESG investors going, hey, wait a minute, now the benchmark is 45%, and you have a large Canadian oil company coming out and saying, well, we're going to reduce our emissions by 33% or 34% by 2030, it's not enough. Even though maybe a year ago that would have been seen as being very progressive, today in 2021, cutting your emissions by 35% by 2030 may not be enough. And if you can't keep up with what the trends are in the oil patch, you're going to be penalized by getting a lower multiple because you're just not going to attract the large shareholders that big oil companies need to sustain those multiples. So on balance, we really favor those smaller Canadian companies. Look, we've talked about one in our reports, and we're going to mention it again on Friday, that's already hit net zero once. So it's happening, but but some of these larger companies, it's just a race that they're going to have a hard time winning, even showing up, at the finish line with the rest of the pack. It's a real challenge for them. So as investors, I think you have to be careful believing that you're going to be safer going into big oil companies and big integrated oil companies because, while you may do okay. We believe that oil and gas stocks are going to have a nice run here. We've been talking about that for a number of months. I don't see that run ending yet. It will end at some point, but can you participate in that by going into big oil companies? Maybe, maybe not. Probably, they'll probably go along for the ride. But the real wealth creation has been in the smaller names that we've been talking about for months now in our reports, and there's probably still some juice left to go. But boy, these bigger is better mantra, passive investing, bigger is better. That was the playbook from last decade. That playbook, you throw that playbook out.
We'll have more with Ted Dixon right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ted Dixon. Ted, why should insiders buying and selling put it in context?
Well, let's just take a look at the environment situation we were talking about in the previous segment. We've seen some insider buying in one very large oil company that again we're writing about on Friday, and that's good and it's positive. But you have to still ask yourself, are the insiders really in tune with what's going on in the broader investment environment? Is there a disconnect? Look, Jim, I'm as guilty as anyone of wishful thinking, and there's stocks I buy that I think can do well, and I don't give up on them enough. But insiders can also have that same issue. So I think you really have to put the new reality of, is this company vulnerable to outside activism? And that is something that maybe some insiders haven't quite appreciated yet. So, and you can extend that to a number of different areas, not just the environment, but in any type of broader social situation that is likely specific to a company or a sector or an industry, then that's important to do. So, yes, usually insider buying is a positive sign, but it always has to be put in context, and the investing environment, especially ESG type constraints that may be heading the company's way, that may not be fully appreciated, you have to look at. Now so I don't want to make it sound like you have to do that for every company. You always have to assess, I think, outside factors, and insider buying is a great tool. And so what we try and do is we try and put it in context, and we put it in context primarily in terms of the price action of the stock and the valuations of the stock. But there are other factors that that have to be considered, I think, sort of during certain periods of the investing environment. So while price action, for example, if the stock is always falling, if the stock is falling and insiders are buying, that's usually a contrarian signal. I think that's like pretty standard. That's a pretty standard signal. That's a positive. If the stock is falling and insiders are selling, that's a very bad signal. It doesn't matter what the investment environment is. That's a very bad signal. So there are some pretty strong signals that you can take from insiders, regardless of the environment, but you still have to do a reality check in terms of, okay, where are we in the investing environment? Last decade, for example, we saw tons of insider selling in tech stocks, but it didn't matter. It didn't matter because the Fed was there with zero interest rates. You couldn't really apply a discount rate even to earnings way down 2 or 3 decades down the road. You didn't discount those earnings very much, and the growth in the economy was ho hum. So it didn't matter how much insider selling there was in that environment. So the monetary environment is also very important. If you've got a situation where the Fed is raising rates, like in 2018, until the Fed cried uncle, it didn't matter how much insiders were buying. If the Fed was going to keep clobbering the economy with higher rates, with all the debt, and I say that because of all the debt, I don't think it would matter how much the insiders are buying, because the liquidity is going to be drained out of the system, daily, and you just won't have the investors to support the stock price. So the monetary environment is very important. And by the way, that's one reason why I don't think the Fed can really do much going forward, for the next 10 years, unless it's going to really get serious about money printing. And you can say, well, they're doing that now, but I mean really serious. Right now, they're doing their QE and they've got zero interest rates, but we don't have what I would call modern monetary theory. The Fed has just announced it's going to, shut down and sell off its corporate bond portfolio, I believe. Well, that was the closest we got to true helicopter money, and MMT, I think, during the pandemic, where the Treasury and the Fed acted together to prop up the market. Well, they're rolling that back. So, I don't think we've yet to see the Fed having to go full blast. I think that's coming, because if they try to raise rates, they may get away with it, or cut back QE, they may get away with it for a little bit. But I think that with all the debt in the economy, and governments hold, they're in a box. I think that's why you see the gold price, firming up here. I suspect that, we had a drawdown in the crypto area, and we're starting to see it bounce back. I say crypto in the broad sense, beyond just the Bitcoin. So I think that the monetary environment is going to be very important. If the Fed does start to taper, if the Fed does start to draw liquidity from the system, I would look out. I think we would be in for a major hard time for the market until the Fed cries uncle again. But we're not there yet. And right now, we're still at zero interest rates. We're still at the Fed pumping in lots of liquidity. So that brings us back to the energy sector. I still see it as being, for the next little while, being the number one go-to place to take advantage of this Fed money printing as it is now, and zero interest rates. And then we'll see. We'll see how long the Fed will continue its transitory talk if oil and gas prices continue to move up, as I expect they will. They will once we start hearing tapering interest rate hikes, then we may be into a new phase. But we're not there yet.
Ted, thank you so much for chatting with us.
Jim, thanks for having me back.
My guest has been Ted Dixon, CEO and co-founder of IncResearch.ca, his website, CanadianInsider.com. If you have any questions for Ted or any of our guests, you can send them to info@HowStreet.com and we'll ask those questions for you. Our YouTube channel, Talk Digital Network, find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.